Hey, what's going on, ladies and gentlemen? Hope you guys are doing well and having a great trading week thus far. We are nearing the end of the week, so thank God it's almost Friday. But I wanted to take the time today to create a video that I think would be really important for you all to understand and apply in your everyday trading. So, common mistakes and common misconceptions that a lot of smart money traders have that's creating more difficulty in their trading than need be. So, I wanted to go over just common mistakes traders make, specifically in regards to smart money, and how you can eliminate these stupid, easy mistakes that you probably make on a day to day basis to totally transform your trading and exponentially grow your account. So, I'm going to first start off by talking about how one of the biggest mistakes I see a lot of smart money traders make is not taking into consideration the higher time frame. So this becomes a big problem when you're so focused on one particular bias on the lower time frame. I know a lot of people who just trade the hourly, the 30-minute, the 15-minute, the 5-minute. You have to have a holistic understanding and a holistic approach to trading. So you have to do proper top-down analysis because think about it. Let's just say you are trending up on the 15-minute time frame or something like that, right? You create some form of equal low, you run liquidity, sell to buy, okay? Sell to buy, and then you look at pulling back into the sponsor candle, right? Maybe this sell to buy candle not only swept liquidity, but maybe it came into another area of demand or mitigated some form of other sponsor candle or filled imbalance of some kind. And now you're looking at taking price off of the sponsored move that took liquidity, right? Well, if you're only looking at a specific time frame and not understanding the higher time frame, this trade could potentially lose and bust through to the downside and hit your stop loss if you don't understand that maybe on the higher time frame there could be an area of supply here that it came into right there, because maybe we are higher time frame bearish, right? So if we're pushing down higher time frame, this may just be an overall pullback in the market, lower low, lower high for a higher time frame, lower low again. All right, so you're thinking, okay, well, we're going to keep making higher highs, higher lows. Maybe we have a really good setup, equal lows, sell to buy, break the counter trend structure, make that higher high. You want to pull back and mitigate this institutionally sponsored move, but then the trade just completely crumbles back down to the downside and you're scratching your head wondering why it hit my stop loss. Well, it's probably because somewhere in here there was an area of supply that it pulled back up into to create the higher time frame retracement for the higher time frame expansion. So it's so important that you're looking at every single time frame from the weekly to the daily to the 4 hour so you can get a clear bias. Always start with the daily time frame or the weekly time frame for higher time frame bias, and then we can scale in to stuff like this on the lower time frame for our precise entries. However, if we were in a bullish market, higher time frame, then this would have been a great trade because you're trading with the trend. However, if we are in a bearish market, right, there could have been an order region or area of supply or sponsored move that created the lower low that now we have to go and fill or mitigate, which is why we reacted from the level in which we did and we pushed to the downside. In this case, this would be considered the smart money move, in which we would want to pull back and then look for shorts, having the understanding that we're bearish and we shouldn't even be trading this sponsored move here because the objective had already been met. I say objective a lot in our program, and it's very important to understand the higher time frame objective. I see so many traders lose trades simply because they don't understand the higher time frame. And it's really not that difficult to understand if you just zoom out and take a little time to see where these higher time frame objectives are. Where will price go and mitigate? Where is price going to target next? Then we can formulate our trades and create our trades around the lower time frame in conjunction with those higher time frame objectives. So in this case, let's go back. I'm going to take this off. And now let's say we are creating liquidity. We take the liquidity, we break counter trend structure, and then we start to pull back. We haven't come up into objective yet, so we still have room to go to the upside. So now this trade would be valid. We can mitigate, go long, set our take profit right here at the objective, and then look to continue lower, right? And that's when we would look for the overall structure shift because we know the overall pullback is most likely complete because of the higher time frame supply level. All right. So we have to just be careful when trading. So when you think you have a setup, I want you to zoom out to the higher time frame and see if upon the retracement into your area of interest, that start of the retracement actually came into something to the left. Okay, did it come into an area of interest? If not, then by all means, you probably are okay to take the trade. Now, if we're overall bullish here, if we're making higher highs, higher lows, right, and now we're looking at a higher high, then obviously there's nothing stopping this from probably continuing to the upside. Maybe on the weekly time frame or the monthly, there may be some sort of level to the left that we could be in a higher time frame downtrend, but most likely you're probably okay if the daily time frame is bullish. All right. So in that case, if we're bullish higher time frame, you're good to go to buy it. But if we're bearish higher time frame, you need to understand where the pullback into your level of interest came into. Did it come into anything? If not, you're good to go to place the trade. If it did, you may want to reevaluate your trade or maybe just take less risk. It may be okay to assume risk and try to trade it just in case you get lucky, right? Just in case it actually does respect because you have the confluence to begin with, right? Then you can take the trade just in case it just maybe breaks structure or continues to push higher, then you're in the trade. So I want to give you a little bit of an example as to what this means. So I'm going to go to Swiss franc, Japanese yen, and then I'm going to go back to USD JPY and show you the opposite. So in this case, what can we see? We're very bullish, higher time frame. We have to first understand where we're going and what's the direction of trend, higher time frame. Daily time frame, there's really nothing stopping price. We're free pushing up, we're mooning right now, right? We took out higher time frame liquidity, but we continue to push higher. All right, we're making higher highs, higher lows. Now, price could fall right now, and we could break structure and have an overall pullback. That's okay. But for the current trend, we are very bullish. However, what did we see in here? We created equal highs at the right time of day, 8 in the morning Eastern Standard Time. We pushed up, bought to sell. So this was a manipulation occurring around that London, New York session changeover. And then we broke the counter trend structure, closing below the recent swing point. So counter trend were bearish, the higher time frame were bullish. We actually came into a level of supply here that filled in balance here. And we also filled in balance in this region of price as well. So I was a little bit hesitant to sell this. I did, but I did on a lower risk. So we created the draw on liquidity, the equal lows, which means that when we push up, it just gives us more conviction that we're going to sell off because we need to go attack the liquidity because there's equal lows here. We also formed ascending liquidity here. And then look where we mitigated. What time of day? 9 a.m. Eastern Standard Time. That's New York session open for me. We pushed up, we filled the imbalance, we mitigated this sponsored candle, and then we fell. Okay, so I didn't place the entirety of my risk at that position because of the fact that we are technically bullish and I'm selling counter trend. So we have to understand higher time frame first. So many traders out there would not take the trade. And if you didn't take this trade, but understood the concept beforehand, I applaud you because that's very, very safe on your end. That's very smart. In this case, it actually did work out, but probably 9 times out of 10, it probably would have went long because we're making high, low, high, and higher high sequences, right? So in this case, I assumed a little bit of risk just because all of my lower time frame, smart money rules didn't meet. So I did assume a little bit. If I lost, I would have only lost a little bit, but if I won, I win a decent amount. So going back to USD JPY, let's take a look at an example of what, people who don't really necessarily take a look at the higher time frames would look at trading. So let's first start off by talking about the lower time frames. We're making higher highs, higher lows. We're bullish, okay? We make a high, low, high, low. We make a high, we make a low, we make a high again, and we make a higher low. Where did this low come into? Well, previous market structure, many retail traders or even smart money traders would say, okay, well, I'm going to be buying 61, 71, 78. This happens to line up with an area of demand right in here, right? So I want to be looking to buy this. They got in the market and then all of a sudden it came down and hit their stop loss and it switched structure. Well, why did that happen? They would just say, well, I'm continuing with the trend here. I'm buying off of demand, like you tell me. I'm buying off of, at discounted price, like you tell me. I'm buying with the trend, like you tell me. Great. That's fine. But did you look at the higher time frame? I would ask them. And they would probably say no. So let me just zoom out here again. We have to understand the higher time frame. If we're looking to buy here, did this area, did this pricing right in here, did this come into anything to the left that could prompt a potential reversal? In here, there was nothing. That's why we continued. In here, there was nothing. We just continued because we haven't reached objective yet. Where is the higher time frame objective? And this is where you just have to do top-down analysis, ladies and gentlemen. This all comes down to practice. So in here, in this blue box, we actually had an area of interest higher time frame. Now, let me just zoom out here. We are extremely bullish. If price did continue, then great. We would have made some money if you continued to buy. However, there was an area right in here. We can see high, low, higher high, higher low, higher high, lower low. This is where we initially broke the structure back to the downside right in here. And that's where we were bearish since 1998 all the way back down until we started to become bullish again in 2011 until we finally came back up into that same spot today, or really like last week. But anyways, the weekly time frame suggests imbalance. This is where we initially broke structure. We created a higher high and then the final lower low. We finally broke this entire counter trend of years and years and years. This started back in 1995. So we finally broke the trend but created imbalance. Between this wick and this wick, there was only selling that was offered. There was no buying that was offered in here. What's in between these two wicks? Obviously imbalance, but what else? 140.000 psychological level. So we zoom out all the way over here and we can see that's exactly where we came into and had the reaction. So going back to the example, let me go to the 4-hour again. Going back to the example, many people would be taking it off the prior swing point, off of demand, off of imbalance right here, pretty much to the T, 1, 2, 3 pin pattern, engulfing, back to the upside, good confluence for continuations, bullish structure, lower time frame, but nope, we failed to make that higher high because why? We had just come into the higher time frame objective. So if you didn't pay attention to this and you bought it, yes, you would have made some money, but you probably would be targeting a higher high, obviously. And in this case, you probably would have hit your stop loss. So we have to always look at the higher time frame to be able to understand our lower time frame trades. So in this case, we pushed up, we failed to make that higher high because we came into that higher time frame objective. We made the lower low, we broke structure as expected, and we did take a trade within VIP within this supply zone that was once demand, and then the lower time frame zone on the 15-minute for our precise entry for scaling in, which we had with the manipulation during news FOMC event, and then we just continued to fall from there. So that is how you read the higher time frames, and that's how you can place your trades in conjunction with the higher time frames. But understand that if you're trading lower time frame, you need to scale out and understand what the higher time frame is telling you. Did we come into a higher time frame level of price or objective that could probably move price in the opposite direction? Here we did. We finally did, which is why we stopped making higher highs. Now we're making lower lows and lower highs. That's why. The next problem that a lot of people get wrong, or a lot of misconception, is they think that the last bullish or bearish candle is the sponsored candle. And this is absolutely incorrect. What do we know about sponsored candles? Just because we're pushing up, pushing up, pushing up, pushing up, and then we push down, push down, push down, push down, push down, then when we pull back to mitigate, doesn't mean that this is the candle in which we mitigate. That's just the last bullish candle in the bearish candle sequence. What is a sponsored candle? A sponsored candle is one that sweeps liquidity. It has to sweep liquidity in order for it to be considered institutionally sponsored. Because if it doesn't sweep liquidity, then it's probably not an institutional candle, because institutions, they love to then sweep liquidity, free up liquidity, and then move in the opposite direction. Okay, so a sponsored candle is very violent. It moves very strongly in one direction, and then immediately it engulfs back in the opposite direction to get in and get out. So to give you an example of what I mean, I'm going to go over Swiss franc, Japanese yen to where we just were. All right, now understanding what's going on in here. Let's just look at structure now. Okay, we came up into supply. Let's just say we knew that. We were making higher highs, higher lows. Higher high, lower low. Lower high, lower low. Many people would be thinking, okay, well, we shifted structure, we pulled back, and we continued. Now we should pull back like this and continue, and just continue with bearish structure. And they think, oh, okay, well, I'm going to place my trade right here, because this is the last buy candle before the engulfing sell-off that created the lower low. So this must be the sponsored candle. This is not a sponsored candle. This did not take any form of liquidity. It was really just sort of like this dragonfly doji. Yes, we engulfed. However, this was no form of any sort of volatile move. If the institutions are going to get in and get out and then come back and mitigate their orders, you bet your butt they're probably going to do it very quickly. There's going to be some form of liquidity being taken very fast, a very sharp move, just like this one, and then an immediate engulfing back to the downside. Yes, this engulfed, but this never took liquidity. This is just subjective. You can go on the 4-hour time frame and say the same thing. This is the last buy candle here before the sell-off. You can go to the 15-minute. This is the last buy candle before the sell-off. This does not make it a sponsored candle. You have to understand what an actual sponsored candle is. So one, it sweeps liquidity. Perfect. Boom, boom, boom. Triple equal highs. Swept liquidity very violently. Immediate violent reaction back to the other side, in this case downside. Engulfing. Violent. Little to no wick. Very little wick, if any. Oftentimes it will mitigate something prior to the left. In this case, we came in to an area of supply and filled in balance as well. All right. Time of day. What time of day was this created? This was created at 8 in the morning. New York session, London session changeover, right? Manipulation around these session times. So this is the sponsored candle. Even though the structure is like this, you want to think that we're going to run this high and come into the sponsored candle and then make our move back to the downside as a liquidity run to mitigate this. Okay, so again, just because it's the last buy to sell, and you can look at any time frame, right? It's all subjective. I looked at this because if I go to the 15-minute, this is not the sponsored candle. This didn't take any liquidity right here. This move did. This is the candle that swept the liquidity. This was the start of the move that did. We had selling volume in here, and then we pushed up and swept the liquidity. I can go to the 2-hour time frame and look at the same thing. 2-hour time frame, yeah, you could have placed your entry right at the open there. Still would have gotten a good trade. All right, now let's go to the 4-hour. Let's go to the daily. Well, actually, let's go to the lower time frame, maybe 10-minute. I'm just going to play around with this. Doesn't mean that this move is the sponsored move. We can go to the 30-minute. Doesn't mean this candle is the sponsored candle. I don't like when people go like that. And they're like, oh, I'm going to place it at the open or the last buy to sell. Just because it's the last buy to sell doesn't make it the sponsored move. I think so. Now that we already have that down, where do we enter? Now we just have to flick through the time frames to see where the sponsored candle is, or in general, where the sponsored move started. In this case, 1-hour time frame, like I said before, 2-hour time frame, this candle looks good, little to no wick at all, engulfing and then re-engulfing back to the downside, sweeping liquidity coming into supply. So that's a really good region of price. Now, I always say place your entries at the open. Well, in this case, yeah, you could place your entry at the open, but we have imbalance as well between this wick and this wick. So I just placed it right here, got a wick entry. We swept liquidity. So now this is kind of considered a sponsored move. Happened at the right time of day. It swept liquidity. It mitigated something else. So let's scale in and see where it is. So in all reality, it's sort of tough here to see where the actual sponsored move is. You kind of just have to go to different time frames and see. You could classify this as the sponsored candle, but really where the sponsored move started is right here because this was our last selling volume before the big two pushes and then the engulfing back. So really in here, that's why we kind of pushed up, swept this liquidity, maybe mitigated something lower time frame and continued. But nonetheless, the whole point of this is just because it's the last buy candle or the last sell candle in the sequence doesn't make it a sponsored candle. Okay. Next, most of the time, or a lot of the time, smart money traders, or really any type of trader in general, takes profit too soon, or they move stop to break even too soon. This kills your risk to reward. This kills, your overall profit, and this requires so much higher win rate. Why? Because if you're taking profit too soon, that means you're taking volume off the table. That means if price does continue in your favor, you're making less money than before. If you move stop to break even too soon, if you got the direction correct, maybe it pulls back, hits your stop at break even because you didn't move it at the right time, and then it continues in the right direction that you always said it would go, right? That means you have to win probably way more than you lose to account for those differences, to account for the trades hitting break even and then going in your right direction, account for the trades that don't make hardly any money because you took profit way too soon or took too much profit off the table before the real move happened. So let's go over an example, CAD JPY, of what I'm talking about. So let's work for the sake of structure. We're going to look here. Higher time frame, we're overall bullish. Okay, so that's irrelevant at this point. I'm going to talk about if you took a trade right here. So let's just say you had all your confluences. Maybe you're overall bullish, even though we're not, or excuse me, we are, but we're looking to sell. But let's just say maybe we're overall bearish. Let's make it easy. We're overall bearish. We broke structure back to the downside. Higher and lower time frame is in conjunction with one another. We pulled back up into supply. The supply occurred at London session, and then the mitigation occurred in London session the following day. So time and price is good. We're looking to mitigate this level of price. Why? Higher high, higher low, higher high, higher low. Reaction off of demand here. Failed to make the higher high. Structure was shifted, lower low. So now we want to pull back and continuation short. So I think this may have been the 4 hour. Yep. This 4 hour start. The 4 hour start here, buying volume, and then we sold. So really that was the start of this supply zone. So this is not a sponsored move, right? This didn't take any liquidity, but it's supply because we initially reacted off of demand here. Because why do we do so? Well, higher high, higher low, higher high, higher low. This is our last selling volume before the up move. So usually we mitigate that, right? And then we pull back, higher high, higher low, and then continue. Higher high, pull back, whatever the last selling volume is, mitigate, continue, higher low, higher high, right? That's market structure. But in this case, we failed to make the higher high in the sequence, and we actually flipped and made a lower low. So now this demand flips to supply here. So that's why this is supply. We can take it right off that supply. So when we push up into it, we get the entry right here, and then we fall. And we break the counter trend structure. So in this case, you probably could take some partials off the table, maybe move stop to break even, but I probably won't until we come down and clear this low. Why? Because once we clear this low, now we know this is a lower low. This was our real lower high, and we're not to come above this level without breaking structure. Hopefully that makes sense to you. So when people get so amped up because, oh, they're in profit, they're in profit. They don't want to lose this profit that they're in because they got in right here off of the open. They move stop to break even or take partials too soon. They take partials and then move stop to break even, so they didn't make hardly anything, probably maybe a 1-to-1, so maybe 1%, which isn't that bad. But again, you take partials off that 1%, you're not really taking 1% off the table. You may be taking a quarter of a percent or a third of a percent. But then price moves against you, comes back, hits you break even because you moved it too soon, chops around a little bit, and then falls in your overall direction. So you have to let the trade breathe a little bit. Now you're probably thinking, okay, well, when do I move stop to break even? When do I take partials? How much do I take partials? Well, that's really all up to you. That's really up to the individual trade itself and the individual trader. I can't tell you how much partials to take. That's up to you, but I can kind of guide you into when to take partials and when to move stop to break even. Usually, if I'm up at least like a 1-to-2, 1-to-3, I'm probably going to look at moving stop to break even, or even just taking partials at least taking like a percent off the table, right? But in this case, I wouldn't, because technically we could still continue long up until this high, because lower low, this could be a lower high. Up into that 99.999% retracement, it's technically still respecting structure. So we have to understand that. We could have easily come up into this imbalance right here. We didn't, but we could have, which is why, when price started to retrace, I'm thinking, okay, well, we can push up into that imbalance and then fall. So my original entry, even though it was in profit, we could have pushed up a little bit of drawdown, but then overall in profit like it would have been. Okay, so I would recommend, in my opinion, waiting for the lower low to form, waiting for the new structure to form itself. So waiting for the closure. We closed below this level. Right when price did that, we are now probably not going to come back up and take out that high, because simple market structure, lower low, lower high, lower low, lower high, lower low. We would expect a lower high of some kind and then continuations. We wouldn't expect to come back up here. But if we were selling, we need to make sure that we have more room to go to the downside if there's an objective down here. And in this case, well, it is higher time frame bullish, which is why taking this trade would have been, difficult in and of itself. However, even if we were bearish, you still would want to wait for that lower low to form to make sure that price doesn't come up any higher than this level. So that's when you can move stop to break even. That's when you can take some partials off the table. Just in case it does reverse on you and break structure, then you already know that you had a safe level. You took partials at the right time. You made a good amount of money, and you hit break even, because by the time it comes back up there all the way, it's probably just going to break structure. So that's when you know you're safe. But if you do it too early, it's going to hurt you. And it's going to require you to win more trades, because you're not winning those initial trades right off the bat. You're not having that high risk to reward right off the bat because you take partials too soon, or you move stop to break even too quickly. All right, so go back, and as you're back testing or as you're trading, look at levels in which, when would it be appropriate for price to potentially reverse? Well, I would let the trade breathe in here. Once price comes lower, then you're probably not going to come above this level. So moving stop to break even is safe. Taking partials is good because it's down here. You've made that low, because if it does pull back and it keeps going and it keeps going and it hits your stop loss, then most likely it's probably just going to keep going and make a new higher high and break structure back to the upside. So that's when I would most likely take partials and move stop to break even. So this is really for new beginner to intermediate level traders. If you're more advanced and you have experience dealing with when to move stop to break even or partials taken, if you have your own system, then by all means you could do that. But that's just what I recommend to make it easy. All right, next. So many people get this wrong. This is probably why those of you who are struggling in smart money trading, this is probably why you're struggling. Probably because you're trading at the wrong time of day. Trading at the wrong time of day can kill you, because if you're not trading at the correct time of day during market manipulation periods. You're not trading during the real moves. Even if you catch a good entry, you're probably going to see that entry come back down and hit you stop loss or break even or whatever, because it probably wasn't the real move if it's not the right time of day. We have to position our trades when the institutions are most likely going to get into the market. So we know that we have a high percent chance that if we get into a trade during the right time of day, price isn't going to come right back up and hit our stop loss or hit us break even, because if it does, then it wasn't the right time of day. Let's think about it like this. Let's just say that we have liquidity, buy to sell. It's not going to look this pretty every time, but I'm going to make it look pretty for this example. Let's just say this sponsored move occurred during Asian session, and this is like Euro USD, not even an Asian session pair. It's a London and New York session pair. Then it comes back up, it trickles up, and you're looking at selling it right there, right? And then price just continues long, okay? Well, it's probably not the right move. Even if you did get lucky and it started to retrace, then you move stuff to break even, you take partials, whatever, and then price comes back up, runs that high during London, New York session, and then falls again, creating the liquidity run in the real smart money move in which to pull back and sell from, coming into maybe the deeper retracement into a lower time frame sponsored move, right? So that's what I mean by time of day. Time and price is so important. Also, if price goes like this and you want to sell it off the sponsored candle during Asian session and then just totally blitzes through, then London session comes around. Well, London session, New York session could provide for a pullback and continuation, because maybe this was the liquidity run and this was your sell to buy move. This was the real move. So the real true moves and the real true manipulation and mitigations occur most likely during those London, New York session times. So I always say between 2 to 4 a.m. Eastern Standard Time. Obviously, that's different for everyone. If you're on GMT or Aussie time or whatever. 7 to 9 a.m. Eastern Standard Time. That's London, New York session changeover, New York session open. Obviously, 2 to 4 a.m. Eastern Standard is London open. But really, 3 a.m. till 10 a.m. Eastern Standard Time is probably your best time to be looking for setups. There are so many people out there who trade Asian session, not even trading Asian session pairs. Even though AUD/JPY is an Asian session pair, I still don't like Asian session because, oftentimes you just get choppy price action. You get false moves. I like London and New York because it provides opportunities for real institutionally sponsored moves and mitigations. So let me go over an example really quick. I'm going to go to the 5-minute time frame here. So many people were thinking, okay, well, we're pushing up. We're in a bullish territory, which we are at this point. Well, not anymore, but we were. Higher high, higher low, higher high, higher low. We're looking at a higher high. We finally got that higher high. So what do we expect? A higher low. So what else is going on in here? Well, this is really our last sell to buy candle. Sweeps a little bit of liquidity. We have imbalance between this wick and this wick. So, everything else has been mitigated. Everything else has been made efficient. So there's really nothing to play off of. So many people would think, oh, okay, I'm going to take it off of the open here or the imbalance or whatever. Which in this case, you got a little bit of a reaction and then boom, right back to the downside. You lost your trade because you placed your stop here, which is in a regular case, smart to place your stop. But in this case, it's not even a good trade to begin with. It's the wrong time of day. Anyways, you hit your stop and you wonder why. Well, it's because look at the time. You're entering during Asian session. You're entering during the wrong time of day. Look at London and New York session. That's really what I recommend. After about 11 a.m. Eastern Standard Time, you should not be looking to trade anymore. Any new trades for that matter. Any open trades, yeah, you can probably leave, right? But you shouldn't be looking to trade and open new positions after about 11 a.m. Eastern Standard Time. And then you're waiting until about 2 a.m. Eastern Standard Time to see any potential mitigations in London when London opens, or any manipulation that occurs to start London session. And that's when you can start to be looking for trades again during London and New York session and not Asian session, because smart money will work. However, these are oftentimes false moves, right? So what we could have seen was this. The reaction from this level We failed to make that higher high because higher high, higher low. You would expect a higher high. And then we made a lower low. So now during London session, let's say, because right here it's about 3 in the morning, 2:45, London session's about to open. We could have had, and I know we just roll over to the downside, the yen was very strong today, but we could have had, liquidity and then that push up, buy to sell, and then we could have continued with the trend down here, right? So that 4 in the morning candle could have pushed up and mitigated this once demand, now supply, not a sponsored move, just supply level mitigation, pushing down. We could have potentially pulled back. This is a London session manipulation, New York session mitigation, continuation. That's something we would want to see, and not playing off of Asian session moves. I never had good experience with it, and it makes sense because most of the manipulation occurs around the currencies that produce the most volatility, that produce the most, that are transacted the most. Euro, pound, dollar, Canadian dollar, really those pairs or those currencies. All right, so that's why I just like to trade London, New York session only. All right, my next one, another misconception, or not misconception, but another problem that smart money traders face is over leveraging and over trading. So over leveraging, people get excited. They trade a lot. They maybe win quite a bit of trades in a row. So they're on a hot streak. And they think, oh, well, I'm good. I'm going to keep going. I'm going to keep going. And they don't humble themselves. They don't understand that winning streaks do occur, but so do losing streaks. So they go from 1% and then they risk 5% on the next trade because they're on a hot streak, and then boom, they lose that trade. And then they just lost all of their winning streak returns. And then they go back and revenge trade that because they want to make it back because they don't like losing everything they've made before in one trade. That just leads to over trading. It leads to, improper emotion and psychology. And it just all in all leads to blown accounts and loss of your capital. You have to be able to consistently use the same percent return every time, or not exceed a certain percent return every time. I haven't exceeded 1% return, or 1% risk per trade since I probably blew my first account in my first trade back 5 years ago. I learned risk management quickly. I was humbled very quickly. So I do go on winning streaks. Heck, VIP, we've been killing it this past few months. But that doesn't mean we need to be over leveraging our next trade to try to make even more and more and more. Keep your risk the same. Stay humble, because when you do go on losing streaks, which we have before, and I'm sure we will again, you're maintaining proper risk management. That's what's going to keep your account afloat. That's what's going to keep you humble. That's what's going to save your account and allow you to trade for the next day. Over trading, same sort of deal. When you're losing and you're kind of revenge trading, you just keep trading and trading and trading, try to make that money back. Or, you're just in the constant cycle of, I want to make money. I want to make money. My trades, are just chopping around. They're coming back down to break even. I got to make money. I got to find a trade. If there's no setup, why are you trading? Don't over trade for no reason. It's just gambling. You don't want to be doing that. Next, not understanding proper risk to reward. All right. So this is very important, and I'm going to draw this out for you. Okay. Many people, and this is what separates the amateurs from the professionals. Let's just say you're pushing up, you're in a bullish market. And like the example before, boom, 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 sell to buy. Okay. Let's just say we have a higher time frame, area of interest, area of supply, higher time frame objective resting right here. We sweep liquidity. Okay. We take the liquidity. We come into some sort of sponsored candle. So we have all the confluence, right? And now we're looking at taking it off the mitigation. Price hasn't come up into objective, so we're good. We start to pull back. We know we have more room to go to the upside. Okay, all the confluences are there for a proper trade. Now what does it come down to again? It's not just finding the trade, but it's also what is your risk to reward? And this just is all subjective. I personally don't trade less than a 1 to 3, no matter what. Really a 1 to 5, but if I get all my confluences with at least a 1 to 3, I'll trade it. If it's anything lower, I don't care how many confluences I have. It's not a part of my trading plan. And I'm going to tell you the reason why that's so important here in a second. So if we have our entry off the open, and then we have our stop loss right at where the sponsor candle closed, let's just say 21 pips, make it pretty. 21 pips, and we have our take profit right here at our open of the objective in case price, we get into the trade, we're making some money, and then all of a sudden it reverses because it hits the objective and we go short. Well, what risk to reward are we getting? That's a 1 to 1. Let's just move it down a little bit. Let's give it a little more room. All right, let's just say it's a better trade. Okay, here and then here. Okay, I'm going to move this down. Back up here. Let's call it 14.5 pips, and then price up into there, the open. 1 to 2. All your confluences are met. Equal lows, snag, break of counter trend structure. This is the sponsored move occurs at the right time of day. We mitigate something to the left. Maybe we fill in balance. Who knows? We're in the right direction of trend. We haven't hit the higher time frame objective yet. We pull back and mitigate at the right time of day. Great, we have a perfect entry, perfect setup, but guess what? Our risk to reward's a 1 to 1.94. So that essentially means that you have to be above 50% win rate to consistently hit 1 to 1.94s or 1 to 2 so that you're profitable. Think about it. If you are, and in all reality, if you talk to any professional trader out there, if you're more than 50% win rate, you are doing phenomenally well. And I know many people are thinking, oh, I do more than that. I do 60%, 70% win rate. In all reality, you probably don't. And even if you do, your risk to reward isn't high. And you don't do it consistently. All right. I'm sure there are traders out there who can do it consistently, who have a high win rate and who have high risk rewards. Congrats to you. I'm sure you're making it a great career out of yourself. I'm sure you are. However, doing something like that is nearly almost impossible to do, having high risk to reward and a high win rate. What does high win rate mean? What is a win rate? That means you place your trade and it hits your take profit without you taking partials, without you hitting stop loss, without it hitting break even. It goes from your entry to your take profit, and you actually make 1.94%. You don't take any part, because if you take partials, you're not hitting 1.94% because you're taking volume off the table, which is, lowering the amount of money you will be making when it hits take profit. So that is not a full 1 to 9 or 1 to 1.94 if you're taking partials. If you're going into profit, oh, I'm going into profit. Oh, it hits me break even. You didn't win the trade, so you cannot count it. You will have to count that as just break even or no trade. So you will have to hit from entry to take profit and actually get the risk to reward that's marked up at least 50, 60, 70% of the time. It's pretty hard. Unless you're scalping. If you're going for like 2 pips, then yeah, okay, your win rate can be high, but your risk to reward isn't going to be anything. It's going to be like almost negative. It's just going to be terrible. So I guess the whole point of what I'm trying to say is, if you know that maybe you're only 30% profitable, or your win rate's 30%, 40%, let's just say 50%, right? 50%, that means that you need to win at least two trades out of every 3 to really be profitable. Okay? Because if you win one, lose the next, let's just call it a 1 to 2. You win one, that's 2%. You lose one, you're back at negative 1 or 1%. And then the next one, if you win 3. If you lose that, you're back to break even. So technically, in order to be profitable, you have to win 2 out of 3 trades. That's 66%. If you win one, lose one, and then hit break even on one, then yes, I guess you're technically profitable. Doesn't give you a lot of wiggle room. But if you win one and lose 2, and you're 33% profitable, you're break even. All right? So you have to have high risk to reward trades. So for me, this wouldn't fly. I need at least a 1 to 3 if all my confluences are aligned. If I have all these confluences here and I still have this risk to reward, there's no point of me placing this trade because I know that based upon my win rate and my average risk to reward that I want, this is not good enough. Even though I will most likely win the trade, but what if I don't? It doesn't provide me with the risk to reward for that potential of when I win. It makes me have to win more trades in order to remain profitable. If I have a high risk to reward, let's just say, my entry is right there, my stop is right here. There, I have a 4 pips. Well, okay, I'm just gonna make this up. 4 pips. Then it's all the way back up here. It's a 1 to 9. That means let's call it a 1 to 10. It's almost 1 to 10. That means I can lose 9 trades in a row and win the next one and be profitable. That means I can be 10%. My win rate can be 10%, and I can still be profitable. See, that's what you need to aim for becoming a professional trader, because you're going to lose trades. So the better your risk to reward is, the more trades you can lose and still be profitable. So that's what separates the amateurs from the professionals. Amateurs would have taken something like this. They would have taken that because they get so excited that they found a setup that meets their rules and they want to take it, but they don't understand the statistics. They don't understand calculations and percentage return and average win rate. They don't take any of the numbers into consideration, which makes them just an amateur trader. And that's okay. It's a start. At least you're seeing the concepts, which is good. Maybe you're making some money. But if you really want to do this as a career, and I always say, if you're not wanting to do it as a career, if you're not wanting to treat it as a business, you probably shouldn't be in it in the first place. Don't treat it as a hobby. If you treat it as a hobby or a side hustle, you're only going to lose money because you're not taking it 100% seriously. You need to treat it like a professional career or a business, to where your sole focus is trading and learning and developing the right plan to trade. I'm not saying maybe 1 to 2 risk to reward is good for you. Maybe you do have a high win rate and that would be fine. But for most people, that's really not the case. So I would recommend not taking something like this. Maybe scaling in to something deeper into this sponsored move. Maybe there is an imbalance or a tiny small level of sponsored candle right in here that you could play off of. Maybe something like that. And then you go from, let's call it 9.5 pips. You go from a 1 to 2 to a 1 to 3.5. That's good. That means you can lose 3 trades in a row, win the 4th one, and still be profitable. It gives you 25% win rate. That's probably pretty good to achieve. Pretty easily, I wouldn't say easily attainable, but that's probably attainable for someone who has experience. All right, so aim for stuff like that. All right. My last one, and this kind of was, I was tying this all together to formulate the last thing here. Not having the right psychology. Not having the right psychology plays a big part in smart money trading, really plays a big part in any form of trading or any form of investing. So many people out there cannot manage their emotions properly. They don't have the right psychology, and at the end of the day, they continue to fail. Managing your emotions is one of the most difficult things to do in trading. You lose a trade, the natural instinct, the natural feeling is just quitting, or just terrible feeling. Like I can't do this, like this is just terrible. There's no pick me up. There's no euphoric feeling. There's no sense of I can do this. Working on your psychology, because the market doesn't care. You lose a trade, you sit around, you suck your thumb in the corner. Doesn't matter. The market doesn't care. You try to trade again, it's going to try to screw you over again. It doesn't care about you. You have to beat the market. It's very tough to do without being able to manage your emotions. So with that being said, I explain it a lot better in my psychology video that I made here on YouTube. It's completely free. Go check it out. It's one of the most recent ones that I made. I think I made it last week or a few days ago, something like that. It talks a lot about psychology, how to properly handle your emotions, the hard truths about Forex trading. If you haven't seen it already, I would highly recommend you check it out. I've gotten so many positive comments from it. So, please give me constructive criticism. Give me feedback. Let me know what you think of it. But that video in and of itself could be a game changer for you, and it's completely free out there for you. So I wanted to provide that for you. I wanted to lead or end this video saying that and tell you, psychology is definitely important. And if you have your psychology, everything that I talked about within this video, you can probably clean up because it all comes down to managing your emotions, focus, having a plan, and doing the small things correctly. Because if you don't do the small things, like you may have all the confluences there for a trade. You may understand the strategy in and out and be practicing and back testing. But if you don't look at the higher time frames, you don't understand what an actual sponsor candle is. You take profit too soon. You move stop to break even too soon. You trade at the wrong time of day. You over leverage. You overtrade. You don't use proper risk to reward. You don't know when not to trade and when to trade. Any one of those things could really cause a detrimental effect in your trading. But there are ways of cleaning it up if you do work towards it. But first of all, understand the problem. So I'm giving you the major problems. So now you can take those problems that one I faced when I first started, but many other smart money traders and traders in general face as they're going, which is why 95 to 99% of traders either quit or lose or blow their account. So if you don't want to be that statistic, take some time and really think about all the concepts that I talked about today in this video. It might really help you out and increase your trading really exponentially. So take a look at that psychology video, highly recommend it. But if you are searching for a little bit of a boost, you want a little bit of a kick, you're almost there, or maybe you're just a beginner and you don't really have experience, or you're struggling, you're losing trades, you're blowing accounts, and you really like trading and you want to make it a career because it is so rewarding, and you want to figure out how to do it correctly, I would highly recommend you hop over to our website, www.arielfxtrading.com. Book a free call with us. We'd love to speak to you. We love to put together an individualized, personalized, actionable plan that you can take to see if you're the right fit for us, to see if you qualify for our program, and to see if we're the right fit for you. Everyone has a different trading personality. We want to make sure that we can be able to provide you value. If we can't, then at least we understand that. But if we feel like we can, then we would love to work with you further. But we love to speak about, your goals, where you want to be, where you're currently struggling, and how we can best help you going forward to help you reach those goals that you can achieve. So don't be shy. Book a call. We'd love to talk to you and help you out. But guys, thank you so much for your time. I hope you found value in this. Go check out that free psychology video I created a few days ago. It's really valuable. Let us know what you think about it. Even if it's negative, I don't care. I want to know how you feel. Maybe I can do something better the next time to help you guys out. I want to provide as much value as I can. So thank you guys so much. Have a great rest of your week. Happy trading and take care.